All right. Welcome back to the More Doors podcast. This is episode 21. Today we have two great guests on, and we're going to be doing a panel roundtable discussion. We're going to get started right now. All right, welcome back to the More Doors podcast. I'm excited. We've got two great guests on today, and we're doing a roundtable kick around discussion. So we're going to be talking all things More Doors. That's the More Doors podcast, right? But we got to thank our sponsor. Today's show is sponsored by Deep Blue Capital, right? If you got some money on the sidelines, like a lot of you do, I think I read a report yesterday, like there's trillions of dollars just sitting there on the sidelines.
Probably sitting in high yield savings accounts.
Probably so.
True.
And we're probably talking to you because you know it's sitting in that account, not doing anything. You probably haven't even moved it over to at least a high yield money market account.
Yeah, earning a measly 2%, probably.
Yes.
Not even keeping up with inflation.
So you want to look at investing it the smart way, the right way. They just go to deepbluere.com, sign up. We just hosted a great webinar on how to buy your first apartment complex. We got another one coming up on how to operate that apartment complex because that's a big, big deal. So go to deepbluere.com, sign up, and just get on our calendar. We'd love to talk to you and talk more about what projects we're looking at investing in. We did write 3 LOIs this past week.
That's right.
So we may have some opportunities that we want to talk to you about. deepbluere.com. And then, of course, this show, Jesse makes it look great. Sounds great. Looks good. It feels good. And
the uplighting makes it extra cool.
And when you look good, you feel good.
Word.
Right? All you got to do is go to torstudios.com. If you want to do a show just like this, maybe you got some content you need to create just to get it out to your group of investors. Or
T-O-R-E.
Yes, T-O-R-E.
Tor. I always spell it.
Oh, do you?
Well, because people think it's Tor.
It is Tor.
T-O-U-R.
Not tour.
Oh, boy.
Oh.
Tour.
You say tour?
Yeah, it's a tour.
God. Do you say wheat?
Can you guys stop? Do you need a room?
Yeah.
You want to take a break?
Yeah. All right. Let's bring our guest in today. We're super excited. I like doing the roundtable ones.
Yeah, these are fun.
Right?
So
more mastermind style. Look, we've got Justin and Vlad on. I'm not going to say Vlad's last name, and out of respect, since I can't pronounce it, and I'm not going to say Justin's last name. So, Justin, you go first. Tell us who you are. Give us a brief 60-second synopsis, and then we'll go over to Vlad.
Yeah, thanks for having me, guys. Justin Goodin. I'm a real estate syndicator here in Indianapolis, Indiana. My quick backstory is after I studied finance in business school, my first job out of college was working for a commercial bridge lender as a multifamily underwriter. Did that for a number of years before going full-time into real estate syndications. So now we're active here in Indiana and nearby markets. We invest primarily in B and A class product here in Indiana. And we have a company called Next Level Equity, where we focus on helping passive investors, create financial freedom through real estate syndications. And also a second company, Next Level Financial Modeling, where we help active investors learn the ins and outs of multifamily underwriting, and also have a number of underwriting Excel models that we have online that we created from scratch.
Love it. Love it. It sounds like you need to do the Next Level podcast with Tor Studios.
Yes.
Just goes right in line with that.
Shameless plug.
Yeah. No, not shameless. I'm just going to throw it out there because I'm looking at the website right now. I love it. I do like the name of the company. So welcome on, Justin. We're excited to have you. Vlad, tell us a little bit about yourself.
Yeah, sure. Thanks a lot for having me here. It's really exciting stuff. So my name is Vlad. I'm in Jersey, and I started my real estate career as a realtor, just residential real estate agent. Started flipping, had few houses here in New Jersey as well, and then shortly after realized that you cannot scale as fast as you wanted to doing this small stuff. So got educated, went into Jake and Gino mentorship, and then about 8 months later got into my first deal, my first JV. So we've done several JV deals last year and the years before, to be exact, around 6, and moved on to syndications also. So I do both. It just kind of varies. Love working with syndicators, and because on larger deals you really gotta be hyper focused, and a lot of people don't feel comfortable of asking passive investors for money, but that's how that's the name of the game. So right now we're focusing on the Midwest, very select markets in the Sun Belt, primarily Texas, Dallas, and Houston, and now we started buying in the Carolinas. We have a lot of success in the Carolinas. Very excited for that market. And also, if you look at just the way everything is, it's a lot of exciting stuff happening. Really, it's good and bad, if you know what I mean. But I'm very excited for what is about to come.
Love it. Yeah, no, it's great.
100%.
Well, I just want to dive into it because I know that we started, to respect y'all's time, we started a little late on this. I want to dive in and ask both of you guys, first off, I mean, how many doors are you guys operating currently right now?
So I'll go. Right now I'm about 900 or so. And this year hasn't been, it wasn't as, I guess, wild as last year was. Last year we acquired, I don't know, 7 deals. This year just 3. The first one we closed in March, 128 doors in Dallas, and then there was this dry spell where we had nothing, absolutely nothing was penciling. Insurance was killing the deals. Of course, you got the rates, and the market did not adjust as well. So we had nothing, and now it's November. We closed 3.
Yeah.
So it's just been a complete roller coaster, and I think I know why. It's all about taxes, right? It's all about taxes and money. You have all these people trying to sell before the year end, dumping off properties, and then you have passive investors coming in because they're speaking with the CPAs. Literally happened with me, speaking with the CPA, and they're like, hey, listen, if you're not gonna offset your gains, you'll pay, in somebody else's case, like over $100,000. So they're like, hey, listen, find us a deal to invest in. I'm like, that's not how I work. If I don't put my money in the deal, I'm not going to recommend that deal to you. So you sit, you wait until we really underwrite the deal, make sure it floats, and it's not going to sink because it's really troubled times. And that's exactly how it happens. So about 900 doors now. And we operate.
Great.
Nice.
What about you, Justin?
Yeah, we're active in 500 multifamily doors, another 84 under contract at the moment. We've done 3 deals, counting the 84 under contract so far for 2023, and still very bullish on multifamily and the long-term outlook of real estate in general. So yeah, active here in Indiana and nearby markets.
Love that, man. So, we've talked to tons of syndicators. We do the show every single week, and we're very active in the community. That same idea of it's been tough in 2023 to get things to pencil is something that's been reverberating in 9 out of 10 conversations we're having with syndicators right now. We've run into it as well. It seems that deal flow is starting to pick up now. Whether or not things are getting closer to penciling is another question, but deal flow is certainly picking back up. With time being of the essence on every deal that you're trying to underwrite, what is it that you guys look for in your initial pass to go, look, like when I get the OM and the financials, I'm looking for this right out of the gate to even decide if I'm going to spend 2 hours even diving any deeper on this model, right? I think that out of the amount in a good market, out of the amount of deals you see, you're probably only going to get a certain percentage are even going to work for you. So how do you guys quickly get to that next level? What are the key things that you're looking for?
Yeah, I'll take that first. I guess the 2 main things that popped in my head is I'm looking for upside in the deal. So sometimes I see deals coming to the market or floating around off market where the broker is, sort of like proposing a $50 or a $80 rent increase. And for me, I mean, deals, as we all know, are already difficult enough to get the pencil out. So I'm looking for deals that can have the opportunity to increase rents by $200, $300, something where there's a significant amount of value add in the business plan. And that could be, coming from a rental upside with a standard, interior value add business plan, or it could be, decreasing expenses, maybe adding amenities, adding on other fees. but we look for some kind of significant upside to where we have that incentive and, I guess, where we have a deal where there's upside and we know that it's going to, pencil out and give us those numbers. Another thing is going to be the market or the specific area of town. So, one thing when we're like laser focused on a market, for example, Indianapolis, we know the good areas, we know the bad areas. So the second main thing that I look for is just the actual neighborhood of where it's located.
Sure.
We don't invest in high crime areas or D-class areas. We want to, especially now in this time of the market, we want to invest in, thriving markets, growing markets, places where people want to live, and places that it's like really hard to picture failing in the next, coming years.
Yeah, that makes perfect sense. Vlad, what do you kind of see in that same regard?
Yeah, great question. So first of all, I look for flood zones. If it's a flood zone, I'm out. That's number one. Because insurance is really killing a lot of the deals. We're not even that active in Houston anymore due to being a coastal town. We moved up to Dallas, so no war zones whatsoever. If you don't want to be there after 5 p.m. collecting rent, I don't want to buy it.
Yeah,
that's one thing. Now, of course, everybody looks for, you have the income, 1/3 of the income. Everybody knows this. But one thing that I actually learned, which is pretty cool. So the rent, the current rent should have at least 20% upside versus average market rent. So if I can hike it up by 20, I'll look more. And also, it's a pretty cool thing. I just learned it at a conference. So if you look at average market rent, it should be 1% of the price per unit, right? So I'm just gonna break this down.
It's a 1% rule, basically.
Exactly. Yeah. So if you have $1,000 you can charge for rent, the price per unit should be $100,000, right? So if it's 800, then it's $80,000. So it's a pretty cool way of quickly going through the deals, and you have to really quickly go through them. This year alone, it's November, we looked at over 210 deals.
Yeah.
Wow.
210, and we're not everywhere. Like I said, Kansas City, that's where we look. Kansas City, MSA on the Missouri and the Kansas side. Dallas.
Oh, we lost your audio, bud.
Oh no. Oh, I can still hear us. Oh no, we lost you. So sorry, Vlad. Oh, he's freezing up. We'll cut this part out.
Yeah, we can cut this out.
Yeah.
Yeah.
Jesse at the, what is that, 13-minute mark?
Sorry, can you hear me
there
now?
he is. He's back.
Okay, awesome. Okay, so I don't know. It's probably my mic. Anyway, yeah. So we look in Dallas, we look in Kansas City, and the Carolinas, both of the Carolinas. So we're not all over the place. We're hyper focused on particular markets that we know. So these are the few things that we look at, and we looked at over 210 deals this year. Just 3 of them penciled.
So 3
of them penciled.
So 210, and you said 3 penciled. Did you send LOIs out on any of the other ones though?
Oh yeah, we sent I would say 30 to 40 per. I would say 30 per month. We send them out. We literally send them out.
Wait, you send 30 LOIs out a month?
We do. We literally do.
Wow.
And I'll tell you why. We contact the broker. Before, we used to contact the broker and we go, hey, listen, should we even, give you an offer on this? And before they were like, no, you way too far off. Now they say yes. They say yes. We're 20% under your whisper price. Should we do an LOI? They're like, yeah, send it in.
Wow.
We ask for it, and they're like, yeah, just send it over.
So Vlad, how do you underwrite 210 deals in 10 and a half months?
4 underwriters.
You have 4
really
underwriters
working nonstop.
Yeah. And so those are obviously, is that all in-house? Those are partners of yours? These are
Yeah,
just, wow.
exactly correct.
Mhm.
Yeah, there's we have a system where few do initial underwriting, then when it passes this point of like, hey, listen, we should look further, then we have two more, and then it gets to the final person who just says, hey, listen, submit or don't submit.
Yeah.
So we have we underwrite in stages.
Yeah. Wow.
Not everyone just gets everything. So,
Yeah.
like, for example, I look at quick napkin underwriting just at that criteria, goes to the next person if it passes, then to the next person, then to the next person. But yeah, we have one person that's literally calling brokers nonstop
Wow.
all the time. I can show you my Asana. It's just absolutely crazy what's happening there. Over 210 deals. And we ask before brokers said, nah, you don't have to, you too low, they're not going to accept or anything. But now they're like, submit, just shoot us an offer. Submit.
Yeah. Well, you can't win if you don't play the game. And I would tell you, I mean, we're in North Texas MSA as well. And it feels like a lot of deals that we put LOIs on that we didn't get the first time are falling out and coming back to us,
Yeah.
right? So if you don't submit, they're not going to come back.
They just want to bring sellers down to earth.
Yeah.
That's all there is.
I fundamentally believe that. And I'd like to get your opinion on that as well, Justin. And like, I fundamentally believe that. I think that as operators, we actually have a responsibility to the market to submit our LOIs at the prices where they pencil. Because if we don't do that, then sellers don't get a dose of where the market is at right now, and they're not able to come to that reality, right? If I'm selling an asset and I get LOIs that are 20% under my whisper price, and I get 15 of them, right, and they're all the same there, I've got to accept the reality of where the market is. But if those buyers aren't submitting LOIs, then I'm never going to understand that. I do think that we have a responsibility as buyers in the marketplace to drive the reality of the market. I think that's why you should submit on everything. I agree.
Absolutely. I totally agree. When it comes to feedback, I think it's key to everything. Like, I'm being a residential agent in New Jersey. I always say, give me feedback. What do you like? What don't you like? I mean, you spend 3 hours underwriting this thing. At least you can do is shoot me an offer or give me something, because it helps me to gauge where I'm at, right?
Yeah.
So you have to submit feedback. And I'll give you another example. Not us, but the team that I work with, 11 months and 7 offers, they got the deal on the contract. Just think
on the
about
same the same mass 7 offers on the same deal.
7 offers on the same deal took 11 months.
Wow.
And they got the deal. So if you submit an offer, don't mean you have to stop. Keep going. Keep going. In a month, call them back. Hey, how's it going? How's the situation? Is it available? Do you have updated financials? Let me revisit it. Call again. 11 months and 7 offers, they got the deal. I'm not a part of that deal, but they are. People who I work with. So that's how it has to be.
That's really, really good practical advice. And so I heard you mention Asana in there, and Justin, I'd like to understand, your process as well. What tools do you guys use to keep everything organized to go through your process? You're underwriting hundreds of deals a year, and you need to be circling back. Let's start with you, Justin. How do you guys operate in that regard? What tools do you use? How do you keep everything straight? How do you work your product? Just give us kind of an overview.
Yeah, we use Monday.com. We also use Google Docs a lot to store underwriting and OMs, things like that. And yes, like just going back to the point of where offers usually come in at, we've, in the last few months, we've been around 10% to even 20% off the broker guidance. We, kind of like what Vlad mentioned, but we're still a fan of submitting where the price, makes sense for us. And typically we're underwriting to a little bit of a higher interest rate than we think we're actually going to achieve. If we go under contract today, but the deal takes 2-3 months to close, nobody knows what interest rates are going to do in that 2 to 3 month time frame. So we're giving ourselves like a little bit of a buffer in the underwriting as well. But yeah, to answer your question, we're still seeing a little bit of a bid ask spread in the market. We use Monday.com, Google Docs, And that's typically how we stay organized.
Nice. Question for you, Justin. How many deals do you think you and your team have underwritten this year?
Yeah, I was thinking about that when Vlad was answering. If I had to put a number, I would say it's probably like a little bit less than 100. We have just a very strict criteria of the deals we look at. So if it doesn't fit our criteria, which is 75 units to 200 units, located in a major market in Indiana or built after 1985, I mean, we're probably not going to look at it unless it's like a really killer deal at an awesome price point. We just have a strict criteria of deals we focus on, so we don't waste anybody's time, and we just know what works for us, and we go after that criteria.
Nice. So I do want to just kind of double tap into something here. We had Chris Pomerleau on the show last week, and he had talked about how he ultimately expanded into different markets, right? So Justin, sounds like you're really focused on high growth areas in Indiana. Vlad, you're in Jersey, investing in the Carolinas, Texas, Kansas, pretty much anywhere else but New Jersey. So how do you make the leap into going from a localized investing strategy to a pseudo national investing strategy?
Yeah, listen, when it comes to Jersey, it's a blue state. That's number one. It's not landlord friendly. It's not as business friendly as, for example, Texas. The growth, obviously, I'm not going to talk about all the numbers and growth potential in Texas or the Carolinas. So the key thing here is partners. That's number one. That's number one. So it took me over 9 months to vet my partners and kind of work with them before we even done one deal. It's very important to have boots on the ground in each of those areas. And I don't work with a lot of teams, literally with two. And I know them. We've done deals with them previously. And everybody knows each other's roles, right? They know we know each other's strengths, and we know what we can do here. So if ultimately the deal is not working due to financials, we're not going to pursue it. But we know in that particular area it will. We're just going to add more people to the current deal. So investing in we look in just red states.
Gotcha.
If Rod Cleve can say it, I can say it.
That's fair.
All right, so guys, let's kind of talk some numbers here. We've very, very quickly pivoted to a much different investing environment, right? Where there was a lot of green and a lot of up and to the right momentum in this market for a really long time, and now it's flat and declining in many areas, and you have the kind of the trifecta pressure of interest rates, insurance, taxes going through the roof, revenue flatlining, and all kinds of stuff. So in the markets that you invest in, what kind of economic changes have you seen that are kind of giving you more caution or pause in your or different things to consider in your investing strategy?
Yeah, I'll take that. Like, just speaking for Indianapolis, it's just always been a very stable, very consistent real estate environment. Like, even during COVID, it was still very stable, very consistent. Nothing catastrophic happened in the market. So I mean, we're still very bullish on Indianapolis and Indiana as a whole. And for us, we're still underwriting, depending on the market in the area of Indiana. But I mean, take for example the deal we're doing now. We're doing 0% rent growth for the first 2 years, and this is located in a A+ area of Indiana, very high growth area of town. And while Indiana is still achieving rent growth, while other markets that we're hearing about, like Dallas, Miami, Austin, are either flat or negative rent growth, Indianapolis is still achieving around that 3-4% mark. We're still just being like really cautious, very conservative, and keeping it at 0% for the first 2 years. So it's really hard to picture some of these areas of Indianapolis that we invest in failing, but we're still optimistic, but just being cautious about the deals we do.
Nice. Like that. You're the second guest we've had that has had 0% rent growth for the first 3 years.
Well, and that's what I was going to ask, is that, so, that's a kind of a default assumption that you're running with. Does that, obviously you guys probably use CoStar, Real Page data, things like that. Does that jive with the data that you're pulling, and you're just at 0% risk growth just to be overly cautious?
we're being overly cautious, but
Yeah.
all the data is still showing Indianapolis is achieving and will continue to achieve rent growth. So we
Right.
talk to property management companies, we talk to brokers, CoStar as well, and yeah, just being super cautious
Yeah.
and trying to under promise over deliver.
Love
But
that.
I mean, so at least so far, Indianapolis is still very strong and still very consistent.
Yeah, that makes perfect sense. Vlad, are you doing something similar on the caution side with your assumptions?
Yeah, absolutely. Not as I don't know, not that significant. We do first year zero growth, but don't forget, if we buy on the market, then we still have growth potential there,
Right.
right? With some value add on opportunities. So right now we are like in Dallas, we're targeting 3% growth first year on zero. But we underwrite at 7% rate. Let me just think of a few other things that we kind of look for. Agency, I'm talking about.
Yeah.
But yeah, you have to be super careful when it comes to that. We lock all our rates. Last few deals we've done full recourse.
Really?
Yes.
Okay.
And I know a lot of people say that. Hey, listen, if you think about it this way, if you mess up on a deal, you screwed either way, right? So
Yeah, I mean, you don't want to mess up on a deal regardless.
Yeah.
You want to be going into it with confidence.
regardless, you know what's going to happen. So we have to be very, very careful at that in this particular thing. We underwrite. We have so many checkpoints that we go to. Yeah, we look at various online resources, including CoStar and things like that. Speak with property managers, of course, people in the area as well. So we're trying to be as careful as possible. That's why just this year, 3 deals.
Yeah.
So there's not a lot at all.
Yeah. So I think that what Vlad just said really kind of dovetails nicely into what we've been talking about and how we've been kind of navigating this market, right? We're at 0% rent growth for year one, unless we're doing some sort of rent growth driven CapEx project, right? If we're
100%.
improving the condition that can help justify a higher rent, then we're doing that. But I think we're also being very, very conservative on the timeline to turn,
Yes.
right? So in the last couple, and here's why, in the last couple of years, at least here in North Texas, we could turn units fast because demand was through the roof.
Yeah.
Right. And now with demand petering out and a lot of new supply coming into the market, you have to account for a slower turn. And so what we're doing actually is, regardless of the number of units, we're actually building in a 2-year turn plan, right?
Yeah.
So that we don't have any sort of unnecessary vacancy. Our numbers are padded. If we can turn units faster, fantastic. We just kind of get ahead of the whole project. But we've done both, the 0% thing and then spreading the turn over 2 years. And it impacts the offer price, but it also makes us feel that much more comfortable in our ability to execute.
100%, 100%, man. What are the, so obviously, that there's way more than just rent growth that goes into your assumptions and how those have changed. Insurance, taxes here, especially in Texas, have been they've changed considerably. What are you seeing as far as your default assumptions when it comes to payroll, insurance, taxes, things like that? How have those changed over the last couple of years, and what is that doing, obviously, to your underwriting model?
Yeah, we're growing either taxes and insurance at a higher rate. I mean, typically, like overall, we'll grow operating expenses at a standard 3%. Taxes and insurance, we're doing anywhere from 4 to 5% year over year.
Oh, wow.
Indiana has historically been, compared to other markets, very affordable as far as tax rates and insurance rates. But even now, like we just closed on a property built in 1995 here in Indiana, and our insurance was just over $600 a door for that slightly newer vintage.
Lucky.
So even here in Indiana, we're feeling the effects of interest rates or insurance rates and taxes, things like that. So just being super cautious, getting multiple bids and quotes on everything we do. And before we buy a property, we're always reaching out to a property tax consultant and getting a year 1 through year 5 breakdown of where they think the property will be and get reassessed. So doing things like that before we close on our deal gives us a lot of comfort.
Oh my gosh. I mean,
Yeah.
you just hit the nail on the head there. And I just want to always try to drop in some actionable advice. If you're looking at deals consistently, make sure that you're continuing to have conversations with your vendor partners, your insurance, your tax partners, things like that. Those things change and it can save you from making a big mistake. I mean, our last acquisition was a great example. We talk with our insurance consultant. You know, we consulted with our insurance people before we even put the LOI in and sent them the T12. They said, not a chance. You're insuring it for what they have right now.
Right.
Not a
Exactly.
chance. It was twice as much.
Mm-hmm.
And that was reflected in our offer. And we still got the deal done. But if we had underwritten it at what the OM was kind of projecting, it would have killed the deal.
Agreed.
Would have killed
Yeah.
the deal.
Good points there. So, it's something you just said, Justin, definitely a little bit of a difference here in Texas, right? We underwrite 10% insurance growth through the entire 5-year hold period.
Yeah.
Right. And
Smart.
and that sounds aggressive or it sounds like a big number, but it's actually not. Right. So that's on a $5 million property, your property taxes are called $125,000, right? Ballpark. You grow those at 10%. Actually, I'm talking about insurance.
Yeah,
I'm
insurance.
sorry.
Yeah.
You're we're budgeting $1,100 a door for insurance year one, and we're growing that at 10% a year, right? It doesn't take much for insurance to go up by $5,000, $7,000, $8,000, $10,000 a clip, and that's coming straight out of cash flow. And what I am still very, very perplexed by is the difference in broker vernacular to the marketplace. Okay, so I've seen brokers put deals out in the last 90 days, and in their financial modeling, it says insurance has grown at 3% a year. The same broker is on social media saying that insurance is up 20% this year and forecasted to be up in the mid-teens for the foreseeable future. And they're the ones that are coming back to us saying our offers are too low. I'm like, bro, you got two different messages to the market. You're putting an offering memorandum out saying you're growing insurance at 3%, and you're on social media saying that to expect mid-teens. When I follow your social media guidance, I get to 10% less than your whisper price, and here's my LOI.
Well, they want to make money.
We're the bad guy, huh?
They want to make their commission. They want to make money.
But I feel like I get that there's at some point buyers are going to turn into sellers for a good broker, right? If they sell us a deal, quite frankly, some of these brokers have sold the same deal multiple times. And if we buy a deal, unless we have a terrible experience, it's very likely that same broker is going to be in our top 3 when we consider selling a deal. But you got to take care of us, right? And basically putting us on a wild goose chase, on following our own breadcrumbs for deal metrics is the fastest way for us to move past you when we're considering a dispo.
No, I mean 100%. You want to get a deal done for your seller at the highest possible price, but you're going to become the seller at some point.
Exactly.
You have a great experience. I get that for sure.
Let me ask you this, right? I want to talk about the deals that you currently have, right? You've got, if I remember, Vlad, you've got 900 plus doors. Justin, 500 with 85 under contract right now. Have you changed how you operate currently? Right. Because I know here in Dallas, we've seen some softening in rental demand. And, before, a lot of times we saw property management or self-managed get a little loose and a little soft. Have you guys changed any way how you operate your current properties at the moment?
Oh, yeah. That's we're actually going through it now. We're doing a whole property management audit on our properties and literally looking at everything. Before we weren't that, well, we were concerned, but not as much. We were not such a pain in the butt, if you want to call it that. But now, oh my gosh, we're literally going through the audit now because we see the numbers, the expenses are going up and up, and it's just ridiculous. Not only we thinking for us, but investors also, and at the same time, we want the deal to survive, and so yeah, we going through it now. What a pain in the butt this audit is.
So double tap into that for us, Vlad. When you say property management audit, what are you digging into, and how do you do it?
Yeah, so it's literally looking through everything, all the receipts, everything that they spend money on. And if you think about it, like for example, I'll just give you a literal example. Like
Please.
they're going in the store and buying, a window AC, and we're like, why are they buying window AC if we have central AC in the apartment complex? What for? What are they? Where are they really putting that thing? Or like if a refrigerator can be $500, why are they spending $1,200 on a refrigerator?
Yeah.
I mean, where's the money going to? At the same time, like for example, it can be smaller things. Like if they buy, let's say, a ladder for, let's say, $50 for the apartment complex, why aren't they using it all the time, and why are they moving it to a different location?
Right.
And you might think, yeah, $50 is not a big deal, but it adds up.
Yeah.
It adds up. All these small things throughout months, it's like over $20,000 of unnecessary expenses. And if you multiply by the cap rate, you see how much value. It's just
Yeah.
money is going out the window. So before we weren't we were concerned, but we're like, hey, listen, we're doing fine. Everybody's doing great. But now we have to tighten our belts. Everybody's kind of like looking at financials. But so we're like, something's not adding up here, and we literally started just going through the whole thing. It's a whole audit.
It's so funny you say that. Like we kicked off a couple of workflows on that this week where some of the numbers just weren't jiving, and we have trust in our PM team.
We have trust, but I think that's one of the things
Trust
we've
but
done
verify.
really good in our partnership, or really well, is we've been in a pain in the butt for our managers since day one.
Yes.
This we haven't changed at all. We've been a pain in the ass all the time. Justin, what about you?
Yeah, I was just gonna say the kind of like the golden statement is always trust, but verify, right? And yeah, I can't say like we're doing anything different here recently that we haven't been doing, since we started investing. But yeah, we're taking a close look at the financials every month. So like whenever we get the financial package, we're taking a look at the collected rent, operating expenses, below the line items, and we actually take all that data that comes out of the financial package and we put it in a custom spreadsheet that we built. And so that allows us to track like the actual performance versus how we originally underwrote the property in our original underwriting model. So we do that every month. We usually send back our property management company like a list of questions just to verify things or things we have questions on. But we've been doing things like that ever since we started investing. We've had bad experiences with management companies like everybody. But for the most part, everything in our portfolio is performing really well right now, and we're just trying to keep everything afloat and going well.
Yeah. So I hosted a webcast a couple of weeks ago, and we had two guests on that kind of between the 2,000 and 3,000 unit under management mix, and they were both focused on quality of people and payroll expenses.
Mm-hmm.
And I think about that because I've seen out of a bunch of deals that we've seen collectively in the last 6 months, there's definitely been a bunch of deals that we've seen that were out-of-state buyers who attempted to self-manage from out of state, and those deals didn't end well. And we've also seen a number of deals that were kind of over the traditional 70 unit, you need on-site help, and they thought the way they were going to make their money was by whacking a bunch of payroll when they bought it, and then having those cost savings hit the NOI, and the valuation went up as a result. But what they didn't realize is they were just kind of creating a leaky vacancy and leaky prospect bucket. So have you guys seen anything like that in the market? And are those opportunities prolific and should we be waiting for more? I feel like that was a Brian Force 6 questions.
That was good.
Yeah,
I followed you the whole time because I'm so used to asking those questions myself. Justin, how about you? What do you think?
I have not seen anything like that personally.
Okay.
Yeah, I can't comment on that either.
Okay.
Maybe but I haven't seen that.
Okay.
Yeah.
Oh, I haven't
Maybe
noticed
it's just me.
anyway.
It's just me. I'm the lucky one.
As far as going forward, right? It is interesting that, you know, we're LPs in quite a few deals as well. And I feel like the deals that were done 2 years ago, you know, at least in my portfolio, are not as performing as well as the ones that we've done more recently, because we underwrote for the variables at the time. Those variables have changed quite a bit. And now we underwrite with the current variables and in our current forecasts, and they're a lot different than they were in 2021. What are you guys, you know, what do you think of the market going forward as far as the ability to get deals done that perform very well? It seems like I said, deal flow is picking up. Are you guys seeing in the markets that you're in, are you feeling like sellers are getting closer to reality and 2024 is going to be an uptick in deals? Do you feel like that's coming in 2025 and we're still pretty far apart on the bid ask? Do you feel like sellers are coming back to earth a little bit and we're going to be able to get more deals done going forward?
Yeah, I personally do. I feel like 2024 is going to be an extremely busy year for multifamily transactions. I do feel like, there's probably not a lot of incentive for sellers to sell unless they have to sell.
Mhm.
I mean, if you have a great property located in an awesome area with low fixed rate debt, I mean, it's going to be like really difficult to sell that property unless you really have to. If you sell that property, have the proceeds, you're just going to be looking for somewhere else to buy and invest. So I do think it's going to be a busy year next year for transactions, and sellers will, sort of, come to realization and come down. But that being said, I think there's a lot of properties out there that sellers won't have to sell, and it's going to be difficult for them to, take a loss or sell it where they can.
Yeah, I agree. 100%.
Yeah, absolutely. I totally agree with that. Yeah, but next year is going to be, I think, crazy times. So we have all our systems in place, the teams in place, money, everything to take advantage of the opportunities that are going to come. All these, 1.7 trillion of multifamily loans. Recently I pulled the CoStar list, and I was flagged loans. I was scrolling through the pages. I'm like, oh my gosh, this is crazy. So they're gonna have to sell. That's why you see a lot of people are coming in with these quote unquote rescue funds, or if you call them vulture funds, whatever you call them.
Mhm.
So obviously they know something that we should be kind of paying attention to as well. So if they're gathering and preparing and getting all these billions into their funds, getting ready for the rough time, let's say, whatever you call it,
Sure.
it's rough for the sellers, I guess, who have to sell, and great time for the buyers who have everything in place and they're ready to go. So
Yeah.
it's going to be very interesting.
Yeah, we're very much looking forward to that opportunity too, Vlad. So we'll see out there. Let's compete, or let's collab instead of compete on deals. Just saying, especially in Dallas. Okay.
Yeah. Hey, listen, there's always collaboration. There is never a competition, because there's the deals. There's number one, there's so many deals. There's a ton of them out there. And at the same time, it's just impossible for one or two or three teams to take them down together. So collaboration is the key to this. You
Yep.
cannot do them by yourself. If you look at top operators, and I can just call out a few,
Sure.
they're asking to raise capital. They're asking others to raise money, because money is hard to come by,
Sure.
right? And you have to raise more and more, because loan to cost of value is what is it, 65%. So we
65
have to
right now,
raise the
usually.
rest, and it's just, you have to bring in a lot more money. It's not as easy as it was before. So there's multiple challenges, but
Yep.
it's incredibly rewarding.
Let me jump in
Yeah,
with
go
one.
ahead.
So, have you guys made any sort of specific adjustments to vacancy, both physical vacancy and economic vacancy, concessions, loss to lease, bad debt, etc.? And then same question on exit cap. So, I think we saw numerous times, in the last couple of years, how, you had an entry cap in the 3s and 4s, and the expectation was that you were going to get out of that same deal at that same or better cap rate, and those days have changed. So I think we've seen some cap rate decompression. But two questions: what have you seen? Any adjustments that you've made on underwriting from a vacancy perspective, and then any adjustments on the exit cap?
Yeah, as far as like the economic loss, we're being more conservative on that approach. So we're typically underwriting anywhere from 5 to 7% physical vacancy, and deal by deal basis where they're going to work off our concessions. But as far as the bad debt, that's something we're taking a extremely heavy look at. And I mean, this could be a good tip, I guess. Like when you're looking at a financial report of the T12 of a property, like what they're reporting on the T12 might not be like always like reflective of what they're currently experiencing. So, I mean, we look at the T12, but like when we're underwriting a deal, we'll ask for the 30, 60, 90-day delinquency report.
Yeah.
And that'll give you a really good look of what the, seller has not written off yet. So, I mean, the last thing you want to do is close on a property day one and figure out that they have, 30 tenants not paying rent or under eviction, to where they just didn't reflect it on their financials and write off. So yeah, to answer your question, we're taking a really heavy look at the current operations on the property, how many people are paying rent, how many people are not, and just being like really conservative with our physical vacancy, taking a look at the comps, talking with our property management companies to get their feedback. As far as the exit cap rates, this could be like a whole nother episode, I feel like. It just goes back to investing in really strong, thriving markets. If it's a C-class property in a rougher area of town, I mean, our exit cap rate is going to be a lot more conservative. Whether it's the deal we have now, we're exiting in 5 years at a 5.5 cap. And it's an A-class deal. It's a new development deal. It's in an A-plus area. So it's really hard to imagine an area like this failing. And so we're just a little more optimistic. And in reality, we wouldn't be forced to sell that property in year 5. And we feel like as a sponsor, there'd be absolutely no reason why we'd have to sell it above a 5.5 cap. So, with our market knowledge and with the data that we have available, we feel even a 5.5 cap for this area is very realistic. But again, it just goes back to the market, your business plan, and just the vintage of the property. I feel like those are really big drivers of an exit cap rate.
Nice. So if we were to roll up what you said about vacancy, so you said 5% physical, and then you're taking a look at bad debt and stuff like that. So are you at 7, 8, 9% total between physical and loss to lease and bad debt?
Yeah, physical is going to be, depending on the area, I'll be saying that a lot, but 5 to 7% physical. Bad debt could be anywhere from 1 to maybe even 3%, at least in the beginning years, until we can clean it up and get some better tenants in there. But yeah, anywhere from 6 to 8% is probably a good normal for us.
Got it. And I'm assuming there's no turn involved on that if you're setting year 1 vacancy there, physical vacancy. You're not accounting for any sort of turn. You're expecting a lot of tenants to stay.
Correct. Yeah, correct. Okay. And actually, in our underwriting model, we have a renovation timing schedule that actually it accounts for down months. So it'll make that unit offline when we're renovating it, and then offline for another month while we're remarketing it. So we can kind of play with that figure there, and the model that we use actually accounts for downtimes and makes that extremely accurate.
Nice.
Just taking a note.
We'll have to take a look at that. We use synthesis. We're super happy with it, but I think that's one of the gaps, at least that we've seen in using that model, where you're kind of getting hit with all the CapEx up front and you're not spreading out, over time. So I'd love to take a look at that. Vlad, what about you?
That is a good point. I'm glad you brought that up. So there's a big difference between, physical vacancy that we underwrite for, and then what we call a renovation vacancy. So that's the downtime vacancy where it's being, renovated and remarketed. A lot of models will have that all being done in 1 month, like no downtime whatsoever. So I agree with you there. In that sort of situation, it's a lot more than just that 5% vacancy rule for sure.
Yeah. 100%.
All right. Well, we'll definitely want to grab the link to either your model or your site, and we'll put it in the show notes after the show, because I think that's super helpful, especially on these heavy CapEx, heavy turn type projects.
Yeah.
Vlad, what about you, my friend? What have you done to adjust for an economic vacancy, bad debt, and exit cap?
We literally do the same thing. I mean, I can't even add anything else. We use synthesis. We do use synthesis. Yeah,
Okay.
it's just so yeah, you have, I don't know, you use it. You know how it is. Few, but we kind of tweak it a little bit
Mhm.
To see the important numbers up front. But yeah, we use the same thing
Yeah.
because we buy in. I mean, when it comes to Midwest, I mean, we buy in Kansas City. We see the same thing as Indianapolis. You know,
Yeah.
Indianapolis is a very strong market. Now I actually looked at the report. I'm like, wow, they're pretty up there. So maybe I should kind of look into it too.
Well, I want to be respectful of everybody's time. So let's wrap with this, boys. And we'll start with you, Vlad, because you mentioned a little bit earlier about raising capital and the challenges and things like that. That is one of your jobs. Our jobs as operators is to always be raising capital and providing, partnering with investors that we can provide the opportunity to generate great returns on their money, even when we don't have deals right now because they're not penciling. So what are you guys doing on a consistent basis? What do those day-to-day sort of activities look like that you're going through right now to continue to raise capital so that when deals do start penciling again, you're able to close on time? What does that look like for you, Vlad?
Yeah, we network a lot.
Mm.
We do. In addition to doing things like this and education, we network a lot. Like I said, I'm in Jersey. I'm 8 miles away from New York City,
Mhm.
so arguably that's where the money is.
Yeah.
So yeah, we out there, we speaking not only with individuals but businesses, because in many cases business owners want to move their money into other investments, or they have to move them somewhere, right? So one of the safest, in my opinion, or everybody's actually, is real estate. So
Yeah.
that's what they want to move the money to. Real assets. Forget about this quote unquote diversification when it comes to stocks and bonds, because it's not diversification. We all know that. It's something that they say so they can sleep better at night. That's not diversification. It's all, whatever. One guy actually said this great thing. I always remember it. He goes like, when you have like Elon Musk or something like that comes out on TV and says something crazy and his stock like drops
Mhm.
like $10 million, he's like, I don't want to be in that space where one person can control pretty much all that money. I mean, look. I mean, technically,
It's a really
and
good point.
it kind of stuck with me. So, what is another alternative? Like real stuff, gold, silver, oil. Those are good investments, right? And of course, real estate. That's what we are. And of course, you have tax benefits and everything that we go for. So, yeah, we do a lot of networking. We do.
Vlad's being very humble when he says networking. Vlad does more podcasts than Joe Rogan. I went to Vlad a few months ago. I'm like, dude, how do you do all this?
I've done around 60 this year. My goal was to do 52 or 54 or something like that, but I just knocked it all out, and I'm still doing them. It's a lot of fun. You know what it is? It's all about education. I don't have a fund. Ask me in a few years. Maybe I'll have one then. But I raise per deal. I know it takes longer, but it makes me feel more comfortable. I know where my investors' money going to.
Yeah.
Right. So it's all about that. And in many cases, they feel more comfortable where it's in this deal, not just spread out. So that's what I've noticed. They're like, oh yeah, we want to invest in the Carolinas. I'm like, I don't have anything. Just hold on for a little bit. Oh, I got something. Boom, the money moves over. So I always speak with my investors. I do a lot of networking. I do. And my wife does as well. Like right now, she's not home. She's in the city somewhere networking. So I found a lot of success not only speaking with individuals about tax strategies and returns, things like that, but business owners. Don't forget, business people have money when they move, and they have to move the money somewhere. So
nice, really good point. Really good point. Justin, how about you?
Yeah, I spend a lot of my time educating investors about the markets and the properties we already have. So I post a lot on social media. I get on a lot of Zoom calls with investors, and I'm just like a really data-driven person. So whenever I, talk to an investor it's either their, first time investing in a real estate syndication, or they have, uncertainties about the market or the future, I just like give them the data. I tell them where we invest. I show them actual market reports of what is, currently happening in Indianapolis and what's projected to happen in Indianapolis. I mean, obviously nobody can predict the future. Anything can happen. There's always risk, but all we have available is the data today. So I use that data that we have available to educate them and provide them with more comfort. So in addition to data, I always talk about the properties that we currently have in our portfolio and how they're, performing up to our expectations. So, I give them case studies and like real life examples of what we currently have in our portfolio and how it's doing.
Nice. Cool. Guys, this was a great discussion. How can people get in touch with you? Justin, you go first.
Yeah, I'm on LinkedIn a lot, just LinkedIn, Justin Goodin. And then also Next Level Equity is my investing website where passive investors can go to learn more about our investing opportunities. And if you're looking for more education about multifamily underwriting and financial analysis, you can go to nextlevelfinancialmodeling.com.
Love that, man.
Awesome. Vlad?
Sorry.
Oh, no.
So I have a very unique name, Vlad Arakcheyev. So it's very easy to find me on social media. I'm on LinkedIn, on Facebook. I do Instagram, and I started TikToking. I don't dance on TikTok. I do not dance on TikTok.
You can say you do it. This is a judgment-free zone, Vlad.
No, I don't really.
Okay.
See, I like motorcycles. So my thing is I combine real estate and motorcycles.
I thought you were going to say dancing in motorcycles. That sounded dangerous.
So like I go to a networking event, right? So I ride my bike and I always like, oh, by the way, here I am at a networking event. Oh yeah, if you're curious, yes, I ride my bike. So that's what I do. I kind of do a fun education thing and, kind of make sure that people know it's not all that serious all the time. You don't have to stress and kill yourself. In many cases, if you align yourself with right people and put yourself on the right team, it's fun. It's really a lot of fun and incredibly rewarding for everyone, especially for passive investors. But the key thing is, I always say it with everything: team is everything. It is. Put yourself on the right team and everything will click into place.
Love that, man.
Love that.
Love that. Boys,
You want to take us home?
this has been fantastic. We truly, truly, truly appreciate the time. We'll put all the links to all you guys' stuff in the show notes when we blast this out, and we look forward to connecting and having you guys back. We'd love to do a follow-up later on, see what you guys got going on.
Let's do a deal together. I'm gonna +1 you.
There you go.
Let's do a deal together.
Let's do it.
Let's go.
Let's write 211 LOIs next year.
I love it.
All right, boys. Thank you so much for having us, boys. Go to, or be it on, boys. Check out deepbluere.com. Check out Tore, Tore Studios.com.
Not tour.
Not tour. Tore Studios.com. We'll see you next week, boys. Thank you so much.